Let's get your home loan rate down. We understand how important managing cash flow is for investors. That's why talking to one of our brokers can help you find the best loan options and a better rate. Your Finny loan expert will assess your loan and quickly spot a better option if it's out there. With access to over 70 lenders and a wide range of products, you're sure to get the lowest available rate in the market. Stop worrying about your repayments now and take charge of your financial freedom. Contact a Finny mortgage specialist today on 02 8866 2444 or visit our website at www.finny.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I'm Grace Ormsby, and it is an absolute pleasure to be taking the time today to be chatting through some of the things that we saw last year in the property market and what we might be able to expect from the year ahead. With a name I'm sure you all know, Eliza Owen, Head of Residential Research Australia at CoreLogic. Thank you so much for taking the time to chat today. How are you?
I'm good, Grace. It's good to be back. Thanks for having me.
Eliza, I feel like this is the perfect point in time for us to be having a chat about what investors and anyone really who's looking at a property purchase over the next year can be expecting from 2024. And to do that, we need to kind of take stock of what we did see in 2023 and what that tells us about the year ahead. So you are the best person to speak about this. So obviously we saw some rate rises and rate hikes. They were at the top of everybody's tongue for much of the year. And I feel like that did really set the discourse for the year in property.
That was, I think, one of the biggest surprises about 2023 is the fact that there was pretty stellar market performance in some areas more than others. But even so, the market was incredibly resilient in the face of what is essentially now considered to be the peak of the cash rate hiking cycle. So despite the cash rate getting to 4.35% by the end of 2023, home values were up 8.1% in the same period. That meant that the buyer profile was quite different though, because as interest rates rose, borrowing capacity continued to be limited. A lot of estimates are that borrowing capacity has been reduced by around 30% since the start of rate hikes. And that means that the profile of the buyer in the market is wealthier, or they're being supported by someone who's wealthier. So think bank of mum and dad. And that was reflected in data as well. We saw a lot of the new loans that were coming out from the banking sector were on basically larger deposits. And even though the buyer profile tended to be wealthier and have more savings to support their purchases, they were operating in, I guess, the more affordable end of town, with some of the top performers being, for example, southeast markets of Perth, where values were up over 30% in some house markets. And, you know, people really taking advantage of those lower value markets that they saw having the potential to rise further.
The buyer profile actually is a really interesting one because, especially for all the agents out there who are trying to work out who their target markets are, interesting that I guess you saw that so distinctly within just 1 year. Is it normally the case that you can kind of pull out that kind of buyer profile so readily in a normal operating market?
Yeah, I mean, I guess historically you would expect to just see the market move with what's happening in credit availability, and there hasn't been a lot of nuance drawn out of that. But this year there was so much disparity between growth in the housing market, you know, where the median value is sitting versus what the median household income could actually afford on 20% deposit, that I think it did prompt a lot of people to go digging for why that was happening. And, you know, we're also in the context of a kind of generational shift where we would start to see a lot of older Australians downsizing. So they're unleashing a lot of equity as well, potentially not really relying on debt at all. to make their next purchase. And anecdotally, we've heard a lot about older Australians gifting money to their kids to buy property. And that also started to be documented. And actually, that concept was researched a bit more as well. So there was a great paper that came out from AHURI, so the Australian Housing Urban Research Institute, that provided like a research summary of housing finance for first home buyers. And they're actually starting to provide research and evidence into that banker mum and dad story, which has been growing over time as well.
Is it something then that we can expect is becoming almost the status quo now heading forwards, or is it more just the product of this weird financial climate that we find ourselves in? I guess noting that there could be some rate cuts by the end of the year or the year after. Is this a phenomenon for right now, or is it something that is just going to keep continuing and we'll see more people relying on those different sources of wealth, I guess?
Yeah, great point. And it's probably a bit of both, but it's been particularly characteristic for 2023 because, like you say, 2024 is the year where we could see a reduction in the cash rate. And that is going to create more buyer demand, whereas I kind of see this underlying mismatch of supply and demand, which is very evident in the rental market, right? Mm-hmm. Because unlike the ups and downs of the purchasing market, the rental market kind of kept rising 2021, 22, 23. When interest rates start to come down, that's going to unleash the demand from people who just fundamentally need housing to those that will become interested in buying housing because credit will be more readily available. Having said that, 2024, we also have to take into account potential headwinds for the market because not only are we at this kind of apex of interest rates where, you know, mortgage rates and the cash rate are estimated to be at their peak right now, but you've also got evidence of households being more stretched. So the household savings rate has fallen down to about 1%. It's the lowest since 2007.
Wow.
Right. So the implication of that, so that, by the way, is the flow of household savings. It's not the stock of savings.
Yeah.
Households do still have a lot saved up from the pandemic, but the pace at which they're kind of saving for that flow of income as of the September quarter of last year was just 1%. And so that's going to mean less money going towards accumulating a deposit, right? So that has implications for housing demand. Other aspects of demand include rising unemployment. So that could create a little more risk in the mortgage market and see more motivated selling if people can't service their mortgages. And the unemployment rate is expected to rise to 4.2% by the end of 2024, up from 3.9%. So 4.2% is still a pretty tight unemployment rate. It's lower than the pre-COVID decade average of 5.5%, but that's something to be aware of in the market this year as well, is that, you know, that labor market is going to be a little bit looser. Not only does that affect the risk of some mortgages, but it also affects things like remote work trends. Because if the labor market isn't as tight, maybe not as many employers can negotiate to work in a lifestyle market. Maybe more people are going to be returning to office as a result of that too.
It's also really interesting food for thought there. There's so much more to unpack. We're going to take a quick break. We'll be back in just a moment with more from Eliza Owen.
Welcome back to a brand new episode of the Smart Property Investment Show.
I am lucky enough to be joined by the Head of Residential Research Australia at CoreLogic, Eliza Owen. And Eliza, it's been so fascinating to chat with you already because I feel like everyone who does listen along to this podcast probably is quite clued in to the property market, especially where they are working and operating. But there is always more to be learned. And I have already feel like I've gotten so much out of this conversation. There's obviously so much nuance around what we are seeing. It is an interesting economic climate, as we mentioned before. And really, there's so much that we can learn from what has already happened to guide our perception of what we can expect in the year ahead. And what are some of your expectations beyond what we've already talked about around that labour shortage? The labour issues and the potential for rate cuts later in the year. What could we expect, I guess, then in the first half of this year from the property market?
For the first half of the year, we were expecting to see a bit of a slowdown in demand just because you've got the convergence of weaker economic performance and that really starting to flow through for households with the sort of peak of interest rates. What we've seen so far this year, and we've only got relatively thin levels of data to go off because there's not a lot of activity at the very start of the year, but the daily home value index has shown a further drop-off in the Melbourne market, which was down 0.3% over the 4 weeks ending January 9th. Melbourne, though, is really the only market of the states that is seeing that more persistent downswing trend right now. Aside from that, we've started to see a little bit of momentum pick up across Sydney, so that's sitting up 0.3% in the past 4 weeks. Perth, Adelaide and Brisbane can kind of all be grouped in these markets, which are strong performing, strong sellers markets right now because they're so critically undersupplied from a listings perspective. Having said that, because demand has been so strong, affordability has really eroded. So we're already starting to see in Brisbane, for example, the monthly growth rate was at 1.5% in October last year. It's since eased to 0.9% in the past 4 weeks. So I guess what we can safely say for the start of 2024 is that it's looking like even though the market continues to rise, there's a lot of diversity within that performance. And broadly speaking, the white-hot demand markets of Perth, Adelaide and Brisbane are seeing a little bit of a slowdown in growth. So that's something to be aware of as well. And then I guess towards the second half of 2024, we could expect that dynamic to change if we get a reduction in the cash rate, where, as I noted earlier, any reduction in the cash rate is probably going to boost the amount of buyers in the market.
I mean, it all makes a lot of sense. So it is interesting, though, looking at the data from the last 4 weeks, I'm sure Christmas being in the middle of that probably skews the numbers slightly. We don't normally see many people wanting to be transacting around this time. How has that looked this past year compared to, say, previous years?
Yeah, so funnily enough, there's probably not too much seasonality in the value change that we're observing because you get more seasonality in the volume of transactions. For example, the market doesn't crash over Christmas from a price perspective just because fewer people are buying and selling. And what we often find is that through the seasonal changes of transactions, when there are fewer sellers, there are also fewer buyers. So hence, I think those value changes that we observed through the start of the year are still pretty indicative of the overall market dynamic. It's been interesting, though, to see 2023, values up 8%. It was a massive turnaround from what we saw in 2022 and the initial shock of rising interest rates, where values were down about 5% in 2022. So 2023 marked this kind of full value recovery. And similarly, talk about rising values, but at a slower growth rate. That was also something that really marked 2023 as well, because it was well below 2021, which was kind of the height of the pandemic property boom. And Australian home values were up 25% in the calendar year of 2021. So, we're beyond the frenzy. And I think 2024 is going to be about kind of getting back to normal in a way when it comes to things like levels of supply, when it comes to things like even overseas migration, which has become really topical amid the strong bounce back. Net overseas migration figures are expected to normalize this year as well. So it could be a much more, hopefully you'd hope predictable, but sort of more normal property market this year.
And what do you call or consider to be that normal? Where's sort of that benchmark that ideal, I guess, that we can be looking at?
Yeah, so I guess, similar to what we might aim for with long-term inflation, for example, just a kind of steadier pace of capital growth and not having those kind of shocks to supply from a construction perspective or enormous fluctuations in population changes that we saw through the pandemic. So Queensland's another really good example where, COVID sort of created these really abnormal migration flows where net interstate migration to the Sunshine State peaked at 51,000 people added to the population in the year to March 2022.
A lot.
Yeah, and that was a record, right? So since then, net interstate migration is still high for Queensland, but it's easing off now and it's starting to look a little bit more like those pre-COVID levels. And that's going to be important for, sustainable planning and supply forecasting and all that kind of thing.
Before we go to a break, Eliza, I note that CoreLogic did a lot of work at the back end of last year. You guys are so busy. I don't know how you do everything that you do, but around the best of the best and what markets did really thrive over the last year. And I do feel like that can give us a few lessons about what we might be able to expect as thriving over the year ahead. And what were some of the standouts from your perspective? And maybe shock is probably not the right word, surprises in there that did stand out and do really well over 2023.
Yeah, so from a capital growth perspective, 2023 ended up being a bit of a mixed bag when we looked at annual performance. But dominating the list was definitely more affordable pockets of the market. Mm-hmm. So if we look at the top 10 capital growth of capital city house markets, topping the list are Brookdale, Armidale and Hilbert, which are all house markets of southeast Perth. The median values for houses across those markets are $530,000 or less, and each of them increased by 30% or more over the course of the year, which is huge, coming off what some might consider a relatively low base if you compare it to a market like Sydney, where the median value is 1.13 million. But I think that is an illustration of what lower borrowing capacity did to the market. It diverted that capital flow to where people could get bang for their buck, where people could get value for money. So it was a bit of a mixed bag in terms of the house top performers. So as well as Perth, we saw some more expensive markets in the mix, like Bayview, for example, in Sydney, where the median house value is over $3 million. But that was more a reflection of, I guess, the first half of 2023. You saw the high end of the market kind of steaming ahead. Mm-hmm. By the end of the year, those same markets had started to fade a little bit. So the mixed bag was kind of a reflection of the market transitioning a little bit over the course of the year. And by the end of the year, it was pretty clear that it was the more affordable markets that were performing a bit better.
Yeah, interesting. And I feel like it's such a good case study in supply versus demand and what people are looking for. I'm sure it was, for you, some pretty amazing data to be seeing over the year. We're going to take another break there, but we'll be back in just a moment with more from Eliza Owen.
Welcome back to a brand new episode of the Smart Property Investment Show.
I am joined by Eliza Owen, and I hope you have been enjoying this episode so far. Eliza, I do have to ask you, based on, obviously, we're crystal ball gazing. I think I need to preface with that. But based on what we did see in 2023, do you have any expectations of what the market will do over the next year? We've already talked about kind of the economic factors that could be at play, but is there anything that we can take from the best performing suburbs that will show us where that supply and demand is going to be felt over the coming year?
Yeah, so I think at least in the short term, it's safe to say that Perth is still leading the pack when it comes to demand relative to what are quite critical levels of undersupply. Even when you consider the forecast population increases relative to the amount of dwelling approvals across our different capital cities. Perth has the biggest mismatch there as well. And I think that it's also evident in the change in dwelling value rankings over time. In December of last year, we saw Brisbane's median dwelling value overtake Melbourne for the first time since 2009.
Which is crazy.
Yeah, and it's something that I think, 5 years ago, a lot of people wouldn't have seen coming. But it does go to show that the pandemic, the legitimization of remote work, and the tight labour market conditions which have maintained that remote work have made Australians put different values to different markets. And that's really shifting the dynamics that we've known for a very long time, which is hugely interesting. And again, just coming back to the growth rates that we've seen in the daily home value index over the past 4 weeks, it does show Perth continuing to lead the pack, Melbourne continuing to show a bit of that weakness. So at least in the short term, I think that reveals, where the dynamics are sitting.
Mm. And I love that you brought up the Brisbane doing so well comparatively to Melbourne. So it's now the third highest ranked capital city, isn't it?
Yeah, that's right. Yeah, behind Sydney and Canberra. So Brisbane's overtaken Melbourne, and the dwelling value is higher by about $7,000. So not much, but based on the growth rates we've observed recently, it's probably going to get a little bit wider, that gap. Mm-hmm. And even other things like, Hobart is still very much in correction mode, and it's just been overtaken by Perth and was also overtaken by Adelaide. So Hobart is now the second least expensive median dwelling of the capital city market.
It almost feels like a bit of a horse race, doesn't it?
Yeah.
Like they'll be neck and neck for a while, then someone will drop back, something will happen. I feel like as well, Brisbane has been all anyone's talked about for so long that while it's a surprise, it's definitely not a shock that this has happened. Probably a little bit earlier, I would just guess, than people did assume.
Yeah, I mean, we have to remember that surge in migration observed through the pandemic is something that can't be met with supply quickly. Developers wouldn't have expected it. Planners wouldn't have expected it. And it does come back to the old adage of supply and demand, but to a very extreme level. It is one that's normalizing, but I think it's going to have a lasting effect on the market due to the lag in construction to keep up with that recent population growth.
Yeah, for sure. So looking ahead, I'm sure we will be having this conversation again at the end of 2024, Eliza, because I absolutely love chatting with you and getting the insights that you have. What kind of conversation do you think we will be having at that point in time? Again, I'm acknowledging that we are crystal ball gazing. We don't know what the year could bring, but based on the data and forward predictions from that, what could it look like?
I think that we're probably, unfortunately, going to be having conversations around affordability slipping even further amid a reduction in interest rates. That's going to create a lot more competition and urgency in markets that are already very undersupplied. So I think deposit hurdles at that point could really get away from us. But at the same time, there will be some adjustments in demand. So we've talked for a while about changes in the number of people per household through the pandemic, which, people really spread out a lot across the housing market. I think in the rental market in particular, we're going to see way more household grouping, share housing, and probably alongside that, more of this migration debate, which was picked up in 2023 because the government is doing reforms in Australia's migration system. That's probably a conversation that's going to continue to remain quite relevant throughout the year as well.
Eliza, thank you so much for taking the time to chat with us today. I hope everyone who is listening along has enjoyed it as much as I have. As always, an absolute pleasure to chat with you. And I'm already looking forward to the next time we get the chance to catch up.
Yeah, me too. Thanks again for having me.
To everyone who is listening along, I hope you enjoyed this conversation, like or review us on whatever platform that you do listen to your podcasts on. And if you have any questions, editor@smartpropertyinvestment.com.au. As always, stay up to date with all the latest on our website, subscribe to our newsletters, and check us out on social media, Facebook, Twitter, and LinkedIn. That's all we've got time for today. Until next time, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.